You know that feeling when you're lying in bed at like 2 a.m., scrolling through your phone, and you see another ad for some investment platform promising you financial freedom? And part of you, the tired, slightly desperate part, thinks, maybe this is the one. Maybe this is how I finally get ahead. And then the rational part of your brain kicks in and you're like, yeah, right, it's probably a scam. But you still screenshot it, just in case. I've been there. More times than I'd like to admit, honestly. My name is Synth, and I spend way too much time thinking about money, investing, and why some people seem to build wealth almost effortlessly, while others, smart, hard-working people, stay stuck in the same financial patterns for years. And here's what bothers me most. We live in this weird moment where there are more investment options than ever before. More platforms, more apps, more gurus telling you what to do with your money, and yet most people feel more confused and overwhelmed than ever. So I decided to do something a little unconventional. I took $10,000, real money, not some hypothetical example, and split it across three completely different investing platforms. Not to find the best one, because honestly, I don't think that exists, but to see what actually happens when you stop overthinking and just start. To understand the real differences beyond the marketing. To figure out what these platforms don't tell you in their glossy ads. And what I discovered surprised me, not in a dramatic, clickbait way, but in a way that fundamentally changed how I think about investing, risk, and what it actually means to grow wealth in 2026. Because here's the thing, the results weren't really about the money. They were about something much more valuable than that. Let me set the scene for you. It's January 2nd, because of course I'm the kind of person who starts financial experiments right after New Year's Egg, when everyone's feeling motivated and optimistic. I'm sitting at my kitchen table with my laptop, a notebook, and this growing sense of anxiety in my chest, because $10,000 is a lot of money. It's not life-changing money for most people, but it's real money, the kind of money that if you lose it, you feel it. I chose three platforms that represent three completely different investment philosophies. First, Betterment, one of those automated robo advisors that basically says, give us your money, tell us your goals, and we'll handle everything. The set it and forget it approach. Second, Robinhood, the platform that made stock trading feel like a game, where you pick individual stocks and feel like a Wall Street trader from your couch. And third, Fundrise, a real estate crowdfunding platform where you invest in actual properties without having to deal with tenants or toilets. $3,333 in each, after rounding. Now, the easy thing would be to just tell you the final numbers, how much each platform made or lost. But that would completely miss the point, because what I learned over the next 12 months wasn't about percentages or returns. It was about psychology, about how different platforms fundamentally change your relationship with money, and about the hidden costs that nobody talks about. Let's start with Betterment, because honestly, this was the most boring experience of the three, and I mean that as a compliment. When you sign up for Betterment, they ask you this series of questions. When do you need this money? What's your risk tolerance? How would you feel if your investment dropped 20% tomorrow? And based on your answers, they create this diversified portfolio of ETFs, exchange-traded funds, that basically own tiny pieces of thousands of companies and bonds. The whole process took maybe 15 minutes. I answered the questions, transferred the money, and then nothing. The platform just kind of quietly went to work in the background of my financial life. And for the first month, I hated it. Is that weird to admit? I'd log in every few days expecting something to happen, some sign that my money was working, and I'd just see these tiny fluctuations, up 0.3% one day, down 0.2% the next. It felt like watching paint dry, except the paint was my money, and I couldn't even tell if it was the right color.
But here's what I started to notice around month 3. I stopped checking. Not because I didn't care, but because there was nothing to do. The platform was rebalancing automatically, buying more stocks when they were down, buying more bonds when stocks were up, harvesting tax losses, all this stuff happening behind the scenes that I barely understood, but that apparently mattered. By month 6, I'd check maybe once a month, and by month 12, when I sat down to calculate the final numbers, I realized something profound. Betterment had made me a better investor by making investing boring. My $3,333 had grown to $3,847, a 15.4% return. Solid, if not spectacular. But more importantly, I'd done absolutely nothing to get it. No stress, no second guessing, no panic selling when the market dipped in March or FOMO buying when everything rallied in October. The platform's management fee was 0.25% annually, about $8 on my investment, which honestly felt almost invisible compared to the mental energy I didn't have to spend. Now, contrast that with Robinhood, which was like the complete opposite experience. Setting up Robinhood felt fun, you know? The interface sleek and colorful and designed to make you feel like you're doing something important. You can buy fractional shares of Amazon or Tesla or whatever company you're excited about. There are these little confetti animations when you make a trade. Everything about it is designed to feel rewarding. I went in with a strategy. I really did. I spent a whole weekend researching companies, reading about growth versus value stocks, watching YouTube videos about technical analysis. I created a diverse portfolio, some tech stocks, some healthcare, some dividend-paying companies for stability. I felt smart and in control. The first week was exhilarating. One of my stocks, this clean energy company I'd read about, jumped 7% in 3 days. I remember taking a screenshot and texting it to my friend like, "Look at me, I'm basically Warren Buffett." But then something interesting started happening. I began checking the app constantly. Before breakfast, during lunch, before bed. Sometimes I'd wake up at 2 a.m. and just check. Not because I needed to, but because I could. Because the information was there, glowing on my phone screen, telling me in real time whether I was winning or losing. And every little movement felt significant. If a stock went up 2%, I'd spend 20 minutes researching whether I should sell and lock in the profit. If it went down 3%, I'd spiral into this analysis paralysis. Is this a buying opportunity? Should I cut my losses? What would a professional investor do? There were moments of genuine joy. I bought shares of this semiconductor company in February that absolutely exploded by June, up nearly 40%. I felt vindicated, smart, like I had some special insight. But there were also moments of genuine pain. I bought into this biotech company because some Reddit thread convinced me their new drug was going to be revolutionary. It tanked 30% when the FDA delayed approval. I sold at a loss, feeling sick to my stomach. 2 months later, it recovered, and then some. By the end of 12 months, my Robinhood account was worth $3,724, an 11.7% return. Not bad at all, actually. But here's what the numbers don't show: the emotional cost, the hours spent researching, the anxiety, the feeling that I was always one bad decision away from screwing everything up, the weird guilt when I won, and the crushing self-doubt when I lost. And the returns weren't even better than Betterment, even though I'd spent probably 50 times more mental energy on Robinhood. Then there's Fundrise, which was just different in a way I didn't expect. Real estate crowdfunding sounds complicated, but basically you're pooling your money with thousands of other investors to buy apartment buildings, commercial properties, things like that. You own shares in these real estate portfolios, and you get dividends from the rent they collect, plus appreciation if the properties increase in value. What struck me immediately was the illiquidity. With stocks, you can sell any time. With Betterment, same thing, cash out whenever you want. But with Fundrise, your money is basically locked up. You can sell your shares, but there's a process, and you might not get the full value. It's designed for long-term investing, 5 to 7 years minimum. At first, this felt terrifying. Like, what if I need this money? What if there's an emergency? But as the months went on, something unexpected happened. The illiquidity became freeing. I couldn't panic sell during the March market dip because I couldn't easily access the money. I couldn't check prices every day because real estate values don't fluctuate like stocks do. Fundrise sends you quarterly updates. These detailed reports about property acquisitions, renovations, occupancy rates, and that's it. 4 times a year, you get information. The rest of the time, the investment just exists in the background. I found myself actually reading those quarterly reports, like genuinely reading them, learning about commercial real estate markets in different cities, understanding how interest rates affect property values. It was educational in a way that felt organic, not forced. The dividends were steady, not huge. I was getting maybe $40 to $50 every quarter deposited into my account, but there was something psychologically satisfying about seeing actual money appear. With stocks, you only make money when you sell, so gains feel theoretical, but dividends feel real. By the end of 12 months, my Fundrise investment was valued at $3,598, plus I'd received $164 in dividends. Total value, $3,762, a 12.9% return when you include the dividends. Pretty close to Robinhood, better than if I'd just left the money in a savings account, but again, not dramatically different from Betterment. So here's where we get to the interesting part, the part that actually surprised me. If you just look at the returns, Betterment won, 15.4% versus 12.9% for Fundrise and 11.7% for Robinhood. But I kept coming back to this question, at what cost? Not financial cost, but personal cost. Because the truth is, Robinhood made me a worse investor. Not because the platform is bad, it's not, but because it made investing feel like a game I could win through cleverness and timing. It fed this illusion of control that, for me at least, led to overconfidence and emotional decision-making. I was constantly second-guessing myself, constantly wondering if I was missing something, constantly feeling like I needed to do more. Betterment made me a better investor by removing my ability to self-sabotage. It automated all the things I would have done wrong, buying high because of FOMO, selling low because of fear, failing to rebalance, avoiding tax optimization because it seemed complicated. The platform didn't require me to be smart or disciplined, it just required me to not interfere. And Fundrise taught me something about patience and the value of not having access to information constantly. In our culture of instant everything, there's something almost radical about an investment you can't check every 5 minutes. It forces you to think long-term, to trust the process, to focus on fundamentals instead of noise. But here's the deeper insight that cut through all of this. The best investment platform isn't the one with the highest returns. It's the one that matches your psychology and keeps you from making mistakes. If you're disciplined, patient, and genuinely enjoy researching companies, maybe Robinhood works for you. If you want to understand real estate and are comfortable with illiquidity, maybe Fundrise is perfect. But for most people, and I include myself in this, the best platform is the one that protects you from yourself. Because the biggest enemy of investment returns isn't market volatility or economic downturns, it's your own brain. It's the panic that makes you sell at the bottom, the excitement that makes you buy at the top, the overconfidence that makes you think you can outsmart professional investors, the fear that keeps you in cash, earning nothing while inflation eats away at your purchasing power. I started this experiment thinking I'd discover which platform was objectively best, which one had the best returns, the lowest fees, the most features. But that's not how investing works. It's not a math problem with one correct answer. It's a psychology problem with different solutions for different people. And here's something nobody tells you. The emotional experience of investing matters as much as the financial results, maybe more. Because if an investment strategy makes you anxious, keeps you up at night, or causes you to constantly second-guess yourself, you won't stick with it. And not sticking with it, bailing out when things get hard, is how people lose money over the long term.
There were nights during this experiment when I'd lie awake thinking about my Robinhood portfolio, wondering if I should have sold that healthcare stock or if I was holding on to that tech company for too long. Those thoughts had a cost.
not a dollar cost, but a cost nonetheless. Meanwhile, my Betterment account was quietly compounding in the background, and I wasn't thinking about it at all. One more thing I learned. Returns in a single year are basically meaningless. I could have done this experiment in 2022, when the market was down 20% and all three platforms would have lost money. Or in 2023, when stocks rallied hard and everything would have looked amazing. The year I chose happened to be pretty good for markets overall, which is why all three platforms generated positive returns. What actually matters is what happens over 10 years, 20 years, 30 years. And the platform that helps you stay invested through all of those years, through the good times and the brutal times, is the one that wins, regardless of small performance differences. So let me bring this full circle. You're probably watching this wondering which platform you should use, which one I'm recommending. And honestly, I don't think there's one right answer. But here's what I'd suggest. Ask yourself what kind of investor you are. Not what kind you want to be, but what kind you actually are. Are you someone who loves researching companies and can handle the emotional ups and downs of individual stock picking? Or are you someone who wants to build wealth but would rather spend your mental energy on other parts of your life? For me, this experiment clarified something important. I'm not as disciplined as I thought I was. When given the option to tinker and trade and optimize, I do it, even when it doesn't help. I need systems that remove my ability to make emotional decisions. I need automation, not because I'm lazy, but because I understand my own psychology well enough to know that I'll get in my own way. So going forward, most of my investing happens through platforms like Betterment. Boring, automated, steady. I keep a small amount in Robinhood for what I call learning money, enough that gains and losses feel real, but not enough that mistakes derail my financial future. It satisfies the part of my brain that wants to feel active and engaged without putting my actual wealth at risk. And I'm keeping my Fundrise investment, adding to it quarterly, thinking of it as my decade-long education in real estate. Not because I expect it to outperform stocks, but because diversification matters, and because understanding different asset classes makes me a more informed investor overall. The point is, you don't have to choose just one platform or one strategy. You can create a system that matches your goals, your psychology, and your life. A system that works for you, not one that you have to constantly work to maintain. Investing isn't about being the smartest person in the room or finding some secret strategy that nobody else knows about. It's about consistency, patience, and not screwing up. It's about making decent decisions repeatedly over a very long time. It's less exciting than what you see on social media, but it's what actually works. And maybe that's the most important lesson from this whole experiment. The best investment strategy is the one you'll actually stick with, not the one with the best theoretical returns or the coolest features or the most impressive marketing. The one that fits your life, matches your temperament, and helps you consistently move toward your financial goals without making you miserable in the process. Because wealth isn't really about money. It's about freedom, security, options. It's about waking up and not feeling anxious about your future. It's about knowing that you're building something, slowly and steadily, that will give you choices later in life. And you can't build that if you're constantly stressed, constantly second-guessing, constantly wondering if you're doing it wrong. So wherever you are in your investment journey, whether you're just starting out or you've been at this for years, give yourself permission to find what works for you. Not what works for some finance influencer on YouTube, or what your friend at work is doing, or what that guy on Reddit swears by. What works for you. Start small if you need to. Experiment. Make mistakes with money you can afford to lose. Learn what kind of investor you are. Build systems that match your psychology. And then, when you find something that works, stick with it. Trust the process. Let time and compound growth do their thing. That's it. That's the secret. It's not exciting, but it's real. And in the end, real is what matters.